Hey everybody, Boris BK Forex. Welcome to the weekly technicals for the majors for Euro dollar, dollar yen, and pound dollar for July 24 through July 28, 2017. And of course, the big question facing us this week is Janet to the rescue. After getting absolutely pounded for the last 3 or 4 weeks, the US dollar is very much on its last legs. Euro now is at multi-month highs, almost at like multi-year highs. Aussie was at multi-month highs. Kiwi is almost at 75. Basically, everybody is making multi-month highs against the dollar in one way or another because dollar weakness is the predominant theme. It's not so much really that everybody loves the anti-dollar trade. It's the fact that everybody is very, very skeptical about the prospect of Fed raising rates even one more time before 2017 is over. At this point, the Fed funds futures are giving it about less than 50% chance that there'll be a December rate hike. And that is really the key question because US data has been relatively disappointing to what the expectations was. And the Fed has been unrealistically hawkish. So the question is Ms. Yellen going to maintain her hawkish posture this week? Or is she going to back off and perhaps suggest that the Fed is going to be much more data-centric and data-dependent, and therefore the chances of a rate hike will diminish even further? Given the fact that I think the Fed really, really wants to reestablish monetary normalcy, that is the idea that they want to go back to normal monetary policy, they're going to try and do everything in their power to communicate to the market that rate hikes are still coming. She still sees this very much as a transitory event, that low inflation, slowdown in growth are all transitory issues. She still sees the U.S. economy strong enough and resilient enough to absorb yet more rate hikes as we go forward. So it would be very surprising if she backed off and became considerably more dovish than what her statements have been over the last few months. Therefore, there's a potential here for a little bit of a dollar pop this week, perhaps in anticipation and certainly post FOMC if the language is relatively definitive about the fact that they really want to raise rates before the end of the year, because then that will shift the chances back up to about 50%. U.S. yields will go up, and that will certainly give the euro, dollar, yen, and pound some pause in the rallies that they've had against the dollar. So looking at the calendar this week, actually, yeah, let's take a look at the calendar first, and then we'll take a look at the levels. Looking at the calendar, as I said, there isn't very much aside from the Fed that's definitive as far as market driving events this week. On the European side, we have the IFO, which is expected to be actually a little bit softer, given the fact that ZU was a little bit softer and the PMIs are softer, but nothing really extraordinary. There's no big dives. IFO is still very strong. The PMIs still out of Germany, still very strong. So there's nothing really extraordinary. This is the final readings that we have here that I think is going to surprise the market. On the UK side, we have the GDP reading, which will be interesting. We think it'll be a little bit stronger, and that will be an interesting view here because the pound has been really struggling, and I'm going to take a look at that in just 1 second. But the fact that the pound has been really struggling suggests that this GDP number could be a big tell whether 130 can hold or not. And then on the US side, we end up the week after FOMC with the US GDP reading here on Friday, and that's going to be interesting because certainly, you know, it could unwind a lot of the bullishness that, let's say, Yellen puts into the play. In other words, if Yellen, say, is uber hawkish, but the GDP comes in tepid at best, again, the market is going to basically ignore the commentary from the Fed and reprice. On the other hand, if you have a situation where the GDP figures are actually better than the market expects, the market is looking for a bounce up here at 2.6 versus 1.4, but you know, if we print like 2.8, that certainly will be much better. We are bearish this number because we have a belief that, you know, weaker retail sales and trade balance data should weigh on the GDP and actually surprise to the downside. But there's always possibility of a different read. And if the read is positive, along with the Fed being positive, there is certainly a potential here for a massive reversal in the dollar as the week continues. But overall, really, all of the fundamental forces kind of weigh on the fact that any sort of a bounce in the dollar is going to be very, very transitory here. That we're still seeing a big anti-dollar rally. Although given how strong it's been, I think there's a certainly potential here for a pause as far as the moves go. Now, if you look at the levels, euro finds the very, very big resistance at the 1710. We tried Friday afternoon to rally and take out that level, failed. So it'll be interesting to see. I'm almost certain that they're going to try and probably run this level before the FOMC meeting. But a failure here would definitely, technically, solidify a near-term double top and create a more corrective move back down to the 115 level. Yen is a disaster, no doubt about it. It continues to just simply slide to the downside, but this 110 is a very big support area. It's also a gap fill. We'll take a look at the charts here of why that's so important. And if that fills up, that could provide a more durable support here for dollar yen to the downside, but still a little bit more to the downside. And cable, really this 130 level is so crucial. That's why UK GDP is going to be a very important factor in how well cable responds as we go forward. Let's take a look at the charts here and just see. So euro still massively strong. We've been very bullish euro, but now we're coming up against this very key resist point, right? So if you look at this on a weekly chart, this was a 1710. What is that? 1714, I think. 1714, whatever. 1710, 1740. Bottom line is this whole 1700 level, obviously a massive, massive resist point. If we blow past it, if we're at 1750 sometime during the week, that's a very powerful bullish signal. And we could, at that point, a lot of the banks are forecasting 120, and it could just be a runaway rally. If we start to consolidate, then it's much more likely that we push back down towards the 1500 for at least an intermediate term kind of a consolidation here, with a natural narrative this week that Yellen puts the rally back in the dollar. Now yen, on the other hand, just looks very weak. It's the support here, this 111, held on Friday, but the true support here is really around 110. And if you see this whole gap opening, this was, I think, the Macron opening. Yeah, this was the Macron win. 108 was the close, and then we opened up and we kind of gapped out to around 110. So it's very typically, markets really love to fill the gaps, right? So the filling the gap would pretty much take us around to 109, let's say 109.50 in an imperfect world. It's very feasible. We could see this fill the gap here. The spike low here is what, 108.74? Yeah, we could fill this gap again and retest it. And perhaps that's going to be the more durable support for dollar yen. But for now, it really looks to be one of the weaker trades as we open up the week, and probably more downside action, certainly at least at the 1050, 1000 before the FOMC meeting. The only thing that can change the dynamic here is FOMC meeting and then the GDP numbers on Friday. If those things turn around, then yes, we could have a nice big short squeeze in dollar yen. But if they don't, the drift back down towards this gap fill, very, very likely, which means that we could be seeing 109.50 before the end of the week. And then pound dollar stalled. Pound doing its typical thing, which is one step forward, two steps forward, one step backward, where it does a retrace. The week found we had a big breakout the week following, and this week we had a retrace a little bit. Really held off at this 130 level. This is going to be a make-or-break week in many ways on the GDP numbers. The market is still obviously very sensitive to all the political flows. It's almost impossible to kind of handicap what's going on politically. Nobody really understands how the Brexit negotiations are going to go on. Ironically enough, as I said, the bigger the calamity and the chaos within the May administration, ultimately that's actually bullish the pound, because it suggests that Brexit could be dead on arrival, meaning that they will come to some sort of a much more soft Brexit solution than a hard Brexit solution as UK runs out of options. But regardless, we're going to watch the GDP as a near-term indicator and also see how well this 30-50 trades. Cable really needs to clear the 130.50 to go into this 130.32 area, and that's going to be a very, very big tell this week. So that's the big event risk, and those are the key levels as we look around. Overall, it's still very much an anti-dollar trade for the taking this week, but having reached these very key levels and having now potentially some U.S. positive catalyst this week, caution is to the wind, or caution is warranted as far as trying to take long trades here against some very serious resistance. You really need to see this resistance broken here to get much more bullish the euro trade and the pound trade as we go forward. For those of you who want to spec, it's not a bad spec to try to short with minimal risk here, with maybe 100-point stops across the way, and see if you can pick the top here for a near-term retrace. It seems like a reasonable trade as we start the week. Wish you guys the best of luck, the best trading. Boris, over and out.